bring in Daniel Fuss of Loomis Sayles, Morningstar Fund Manager of the Year in 2009 and various points before and after. Good to see you, sir.
Good to see you, Tom.
Sit there. Don't move the chair because the cameras are all lined up on it. A guy named Gross out on the West Coast.
I've heard of him.
He's light on bonds. Are you light on bonds?
Oh, no, I love bonds. It's which bonds? The standard bond, no. Although it's still very early, I think, to get too defensive with bonds. Nonetheless, my guess, Tom, this is a guess, is that interest rates go up, well, I don't know, for 20 years with interruptions. Not right away, because the Fed is buying.
So you're saying an end of the Great Moderation and a new cycle we saw pre-1979?
Yes.
Let's look at a chart that describes this. I guessed this. I love this chart. It is a dreaded first chart. You're going to see this chart a lot, folks, in the coming months and quarters on Surveillance Midday. A half century of yield. This is called the H15 series from the Fed, and it's a 10-year yield, and up we go, and there's the Volcker peak, 1979, and on we go. And Dan, you're saying this is a big cycle, and we're in a new cycle. It's back to the 50s when you started out.
Yes. That's a good summary. I don't think it gets as extreme as, in other words, that's a hope.
Sure.
And there are some things that could cause me to change my mind. But right now, for the underlying reason that the U.S. Treasury has to borrow a lot of money and will take up more of the savings flows, I think interest rates on a cyclical basis are going to go up. That does not mean you can't get reasonable returns in bonds in nominal terms. Inflation adjusted is a whole nother matter.
We'll talk about that in a bit. Let's look at this chart here. I brought this up a number of times on the show. It's the backside of that chart we just showed from 1980 to 2010. It's an elegant chart, and it's at a regression here, Dan Fuss. And we're sort of, we're getting out near one deviation on that trend, but we're really remarkably on trend. Where do you have the 10-year yield, say, a year or 2 or 3 years from now?
Okay. My guess is that a year from now, the 10-year isn't going to be a whole lot above where it is now unless the economy gets stronger than any of us think. Right now, it's more beyond that, Tom. And the trend is up. How high? To be honest, I don't have the foggiest, other than it goes higher. We're artificially low right now. You know, when you and I were studying about bonds, rates were also quite low, but they were trending up already. And now we've been artificially low for the last couple of years.
We've been artificially low, but you got to make coupon or total return. You're the king of total return. Buy a discounted bond, see a little bit of price appreciation, plus grab the coupon. Can you do that with everything selling at a premium?
No. Not everything sells at a premium, and there are bonds issued in other currencies and in other parts of the world. But it's a time to be a bond picker. And that sounds nice, but it's also very hard to do at this level of rates.
You got a bond here. Here's a Dan Fuss bond. This is from his portfolio report from a few weeks ago. Intel, the 3 1/4s at 21.39. First of all, I shook writing the number 21.39, Dan. And you're going to still be managing the fund then. Fuss and search the total return. Look over there, folks, on the Victor. Get over on the left side of that chart where it says 125. You're buying a premium bond at 125 that comes due at par. You capture a 2 or 3% coupon on Intel. How could Dan Fuss buy a premium bond and sleep at night?
Well, first place, I didn't pay 125, Tom. And you can see that dip. And what I'm guessing is approximately
spring of last year.
Yeah.
You loaded the boat then.
Well, we bought some then. Now this, in a way, you're saying, well, why? Where's the yield? At the time we bought it, we had a yield advantage, believe it or not. slightly to treasuries. We're buying it not for the yield. We're buying it because it has a call on the common stock. And the common stock is very unloved out there.
Right.
And Intel's a cash
So
machine.
did you buy this bond together with the stock? Joint purchase?
In some accounts, yes. But in the bond accounts, we
Great.
just bought the convert. That's a convert.
Right.
That's a convert.
This is a convertible bond we just
Yeah.
showed. Okay, so you
And the
converted into equity.
conversion runs for a long time.
Okay, well, we're going to have to come back. I had no idea that these two gentlemen had never met. I just assumed they met like 35 years ago at some Frank Fabozzi bond conference. Ed Altman of New York University, Dan Fuss
Nice
of
to meet
Loomis
you.
Sayles. I'm thrilled to have you two together. Ed Altman, let me start with you. How messed up is Europe, and what do you see when you look at the spreads there?
Well, they're very messed up in terms of high default risk of a number of countries and the possibility of it, moving even further from just the ones we know about, Greece, Portugal, possibly Spain. However, there are some bright lights that are beginning to show, that I'm beginning to see in countries like Greece. The social unrest that I expected to happen hasn't manifested nearly as much, and they are making some progress. But the huge amount of debt that they have outstanding is still going to be a formidable obstacle.
You, Dan, have owned New Zealand big. You've owned Canada big, Ontario Hydro big. Do you have the courage to go into Europe now, or what are you waiting for? What's the signal you need to see?
We have something. Ed and I have never met, but I've read his book. And what developed in Europe over the past, 8, 9, 10 months, is a series of unexpected deep discount bonds. The ratings following behind, coming down.
The price comes down, the yield goes up.
That's how it works.
That's how it works. No, but I do that because I quote yield on the show. Yeah. Some people think price. It gets confusing.
Well, I get confused. But you had bonds out for the bid, and there was no bid. So down they went. Now, anytime you do that, whether it's corporates or sovereigns or what have you, you better know what you're doing and recognize in advance that there's an uncertainty factor. Greece, for example, that was real brief. Because the European Central Bank came in 3 weeks later and bought most of what we had. The rest of it still sits there, but it's at a low enough price that even if there is some sort of exchange, I figure we probably, perhaps maybe get our money back. In the meantime, we get a nice coupon. Yeah. Ireland's different. Ireland, in first place, it didn't follow quite Greece's pattern, but then finally down it went. And same story then.
Let's look at this chart, gentlemen. You can see it down here. Ireland and German, Ed Altman, I've shown you this chart before. It's just the spread, Irish to German 10-year. And you can see it back 10 years and the explosion up, and we're still elevated. Ed Altman, and I ask both of you, is it better to look at spreads or to look at credit default swaps? Which is a better indicator for you of the tensions in a given market?
I tend to like the spreads better because they're not as volatile. Those CDS things move incredibly much from time to time, and if you watch those, you can be whipsawed. Whereas the spreads, I think, are not nearly as volatile. They do move, of course. What I also like to look at is the downside that you can consider possibly happening at the same time looking at your upside. So, for example, Greece.
Right.
Dan, you mentioned you like the yields on it, and I'm beginning to like the yields on it too. But you have to also think about if those exchange takes place, as they, I think that's almost inevitable, to be honest with you, that there's going to be an exchange, and the bondholder at some point will have to give up something. The question is it going to be 50 cents on a dollar, 70 cents on a dollar, 80 cents on a dollar? I personally think it's going to be a fairly significant amount of, like, 40, 50 cents of a haircut before it's going to be all over, because otherwise the amount of debt is still going to be insurmountable from their revenue ability.
Have they called you, have the governments or the institutions over there called you with your experience and said, not so much what would you do, but would you buy our paper? Have they dialed 1-800-FUSS and said, here, buy this?
In one case, yeah, actually. that isn't a good conversation to have because it puts you don't want to buy new issue. I agree with Ed, but if you can move at 60 cents on the dollar in the case of Greece, I would do it. There is 10 points downside. There's an outside chance of 40 on the upside.
That's right.
A probable, I would have a little bit higher number. I think the probable is going to be roughly 7,
Right.
but it's guesswork.
Okay, yeah.
Just we could go all day, folks. We're going to have a surveillance midday 4-hour show with Altman and Fuss here at some point. It's time to make the coupon. Here's a BAA industrial to 10-year. Ed Altman, we talked about this. There's a lot of default risk, and we've really come in nicely. Dan Fuss, is this a year where you try to make the coupon, or can you make a little bit of capital gain as you've done for decades?
Well, the coupons are good, and the capital gains are difficult. You can take a pretty good degree of risk, and you can buy an Intel convert, what happens if stock goes down, or you can buy a deep discount Irish government bonds. And you've got to watch, in the case of both Greece and Ireland, you do have to watch the euro itself. It has a nasty habit of
taking away your gains, going the wrong way.
Yeah, but it also runs it. You get to your price point in euro, and oh my goodness, the euro's gone from here to here against the dollar.
Right. And
we're dollar based, so we adjust the price point.
Well, people forget
down.
about currency play within the bond market.
Sure.
Within Ed Altman's book, how do you fold in other asset classes into your study of default and the Z-score and credit risk?
You mean outside of the bond market?
Outside of the bond market. How do you fold that in?
Of course, the big question today, and one you haven't mentioned yet, is the incredible change in the correlation between returns on stocks and bonds. Historically, risky debt and stocks are relatively low correlated, 40, 50% at most. The last 3 years, they've been close to 80%. So whatever moves one, moves the other. So we got to be concerned not only with the bond market and the companies in it, but we got to be concerned what's happening in the stock market, because if that takes a hit, the bonds are going to take a hit even though the companies remain strong, and then maybe there's more opportunity later on. This is a sea change, in my opinion, of the way the markets have typically moved.
We've gone beyond an Ibbotson market. For those of you, Ibbotson and the certitudes of 10 and 20 and 30 years ago with his research on equities, we've moved beyond that. It's a new world.
I think the correlations are very new, and I think they're going to continue. We're just so attuned to information now and how it impacts risk. And when talking about risky debt and risky stocks, the same variables impact both.
Yep.
And then you got to look at the individual companies as well.
I'm going to have Ed back. Dan, very quickly here, what do savers do right now? What do the retirees watching this show do?
Oh my goodness, the poor people have been suffering for a long time with low interest rates, and it's going to take time for rates to get up. A couple of things you can do, they're not great, is put together a fairly short ladder of, say, treasuries or something like that. Or you can take a whole lot of risk, and you can go into multi-sector bond funds. But don't kid yourself. Those things go like that. You hope the income rises in this environment, but interest rates might turn around and go down on you, despite what I guess.
Ed Altman with us of NYU. You want to talk sovereign debt. I agree. I want to get to Italy in a bit, but here's the Bahrain, I'll get it. Margaret Brennan's giving me speech lessons on Arabic names. Bahrain expensive protection. Up we go. Are those good indicators of the risk that's out there?
Yes, I think they are the most current, up-to-date. They are, as I said before, incredibly volatile. If you believe that the situation is going to get worse, then they're appropriate. If you think they'll be calmed down, that they'll have a solution there, democracy, whatever, then you're going to be whipsawed. I rarely play in that market, to be honest with you, but I realize that it is by far the most up-to-date analysis, consensus, if you will. Let's take the CDS spread, for example, on Greece. What it was in the beginning of 2009. Relatively high, people were a little concerned. Then it actually went down for about a full year. when things began to deteriorate. Why did it go down? Because the ECB was involved in it, backstopping, and also the stock market went up in many other countries, and that gave people more confidence. In Greece, it went up a little bit. But I think you should supplement, no matter what you look at, with fundamentals. Meaning, look at the health of the private sector in each of these countries and monitor that. For example, right now,
Italy. Let's take Italy.
Yes.
Bring up too much information. I knew where Ed was going on this, folks. I didn't. It's like clairvoyant thing I can't do. Too much information, and you can see the chart there, along with the beleaguered Berlusconi. Altman gives Italy a Z-score, and there's the Italy CDS. This is not Bahrain. This is not Greece. This is Italy. I mean, these are sensitive indicators, and these larger countries, those fundamentals are at issue.
I'll tell you, in the beginning of 2009, my analysis of Italy was that it was no better, no worse than Spain, but certainly one of the lowest average credit scores in terms of the private sector in all of Europe. Yes, Greece and Portugal were worse, but you can, there's an enormous possibilities for increase in productivity in Italy. If they would get their political situation in order and channel that tremendous amount of resources, industrial might, etc., there could be great upside. But if they don't, Italy, I think, is the fulcrum country in Europe. If Italy falls in any meaningful way, the euro is toast.
We're going to come back. Ed Altman, thank you so much.